Hey, what's going on, guys? Welcome to the Real Estate Playbook. My name is Andrew, and today I wanted to just look at real estate in terms of financing, getting you some money, right? We're talking the old school, traditional way, getting a mortgage from a bank. What do I need to do to get money? All right. And as we go through this, I'm going to give you kind of a 10,000-foot overview of just what a loan officer or a bank is going to be looking at when you're looking to receive financing. So, whether this is you looking to get a home, or maybe this is someone you care about, a niece, a nephew, a son, daughter, or maybe a real estate partner trying to help advise a client, or maybe you just know someone in your life that you want to share this with. This is just to give someone, the consumer, an overall understanding of where do you start when you're looking to get financing, right? And you're probably thinking, hey, Andrew, why don't I reach out to someone like you and you can do it for me? Now you can, but just like when you go to the doctor, you probably do some research on your own from what they tell you. You probably want to do some research on your financial health too, right? You don't take for granted when the doctor says, take this medication, or we're going to do this procedure, or follow this plan. No, you want to go do your own research, right? You want to do your own studying. You want to see whether or not this is the right thing for you. And just like you would do that with your physical health, you probably want to do that with your financial health. So before you go meet with someone, these are some good things to think about that you can start planting some seeds in your head in terms of what do I need to do to get my ducks in a row. So we're going to go over here together, kind of from a 10,000-foot view, and just kind of go through what are some things that we should be looking for. And just starting out here, there's really three things that a bank is going to look for when they're looking to give you financing. So number one, your credit. Number two, your income. Number three, your assets. That's really the meat and potatoes of what a bank wants to know about when they're looking to give you money. So when a bank is looking at credit, they really just want to know, have you been responsible with your credit? With the debt you've had so far, have you been responsible with it, right? Have you paid it back on time? Have you paid it back in full? You know, those type of things. And really a scorecard, they're using what's called a FICO. And a FICO is a combination of the three major credit bureaus, and that's how they're going to determine what your credit is for a mortgage. So when you look at the different credit bureaus, you're going to get your credit looked at from all three, which are Experian, Equifax, and TransUnion. So with this example here, we've got 741, 737, 740, right? In this case, we're going to take 740. It's the middle score. That's the one a bank is going to use for decision making, right? And why is this important to you? Why does it matter what your credit is? Well, first off, it can be the determining factor between you qualifying and not qualifying. But assuming you do qualify, it's going to affect some major things that are important to you, right? In terms of the terms and conditions of your loan. So number one, your interest rate. That's something everyone's talking about, right, with financing. So when you are going to have a higher FICO, that's usually going to result in a lower interest rate, right? You have shown in the past that you were responsible with credit, therefore will give you a better deal on your mortgage. That's how that works. Your debt to income ratio, which we will touch on briefly here in a moment. But for the time being, your debt to income ratio is essentially how much money can you take on, right? How much additional debt can you take on with your current situation, right? The better your credit, the higher the debt to income ratio you can have, the more money you can be lent. Your mortgage insurance, right? If you are putting less than a 20% down payment, you're going to have something called mortgage insurance. Now, this is going to be hit very hard depending on what your credit is. So if you have a great credit score, mortgage insurance shouldn't be that big of an issue. If you have a poor credit, look out, mortgage insurance could be pretty damaging. So these are all factors that are going to be affected by your overall credit score. Lastly, I just want to touch on thin versus thick credit. Now, thick credit is your traditional credit. You know, that's credit cards, that's personal loans, that's car loans, that could be a past mortgage, it could be a home equity line of credit. Any sort of traditional financing that comes through a bank, that's called thick credit. All right. And a bank wants to see that there are three active trade lines or three types of traditional credit, thick credit, right? So that is normally what they want to see. However, maybe you're someone young and you say, Andrew, I don't have any thick credit. You know, I'm someone in my 20s. I'm young. I only have one credit card. I don't own a home yet. I certainly don't have a home equity line of credit, right? Or I've only got a car payment or whatever. You're looking at your situation. You're going, hey, I don't have those three lines, or I don't have a lot of proof of having a credit. That's okay. You could have thin credit, which is basically proof of paying other things back. So maybe you're renting right now and you have a lease agreement, right? That you've consistently been paying month after month after month. That could be used as thin credit. Maybe it's your utility bill. Maybe it's your phone bill, right? You can get creative depending on what institution you're working with to help meet that need and to show the underwriters, which are the people who are going to give you the yes or no on your loan, you can show people that, hey, yes, I do have experience paying things back. So you can look at that. That would be thin credit. So the next thing we're going to look at is your income, right? And basically what your income is do you have the ability to pay the loan back, right? Do you make enough money per month to pay the loan back? That is what that means, right? And when you're looking at your income, everyone's situation is going to be a little bit different. So you want to look at what type of income do I have? Am I W-2, right? Am I employee? Yes, Andrew, I am an employee. Okay, what type are you? Are you salaried? Do you get paid a flat fee every month or every paycheck? That would be salary, right? Are you hourly? Do you have a rate per hour? Are you commission? Are you somebody in sales? Are you getting paid a commission check depending on your performance, right? That would be commission. Do you receive bonus? Do you get a quarterly bonus depending on what type of production you're doing or whether or not you're meeting your employer's goals, right? That would be bonus. Are you working overtime? Do you work more than a standard 40 hours a week? Maybe you're in construction. Maybe you're an engineer. Who knows? You're doing something where it requires more than 40 hours a week, right? That would be overtime. And the reason why you want to look at that is because the income you can use to qualify for a mortgage is going to be different, right? Depending on what your income is. For example, all these different categories here, overtime, commission, bonus, they're all going to require a 2-year history. Now, I'm speaking in general terms. Different lending institutions can make different exceptions, but for a general rule here, you're going to have a 2-year history of receiving that type of income. Are you retired? Are you earning retirement income, right? Are you on Social Security? Do you have a pension? Do you have annuities? What type of income are you earning there? So as you're watching this, just think, what boat am I in here? What type of income do I have? Now, a big factor of their income is your debt to income ratio. Now, I'm going to have future videos to come here. We're going to go more into detail on what this is. But right now, we're just going to, again, go over the 10,000 foot view of what this is. So basically, your debt to income ratio is a comparison of the monthly income you make compared to the debt you'll be taking on. So right here, as you can see, it's just a regular fraction, it's a ratio. You're going to take your total monthly debt divided by your total monthly income, right? And that's going to come out to a ratio. And generally speaking, I know, again, different lending institutions are going to have different guidelines, but generally speaking, you want to keep this around 45% or lower, right? 45% or lower. So monthly debt, that would include any sort of those traditional credits you have. This would be a car. This would be a student loan. This would be your credit cards. This would be a personal loan. Maybe you have a camper, maybe you have a boat, all that fun stuff. All those things are traditional debt that you are paying every single month, right? So that is all going to be in the top here with your monthly debt. Now you have all of that plus your future mortgage payment. So that's going to be all the debt you owe the world, right, on a monthly basis, plus your future mortgage payment. So put that together. That's your total monthly debt, right? And you're going to take that divided by what income, right? Going back to our income here, what income that you're allowed to use for qualifying purposes that you're earning per month, right? So total monthly debt divided by your total monthly income, and that's where you're going to get your debt to income ratio, which again, generally speaking, 45% or less. So that's income. Let's move on to assets. So basically with assets, banks just want to see, are you putting skin in the game? Are you putting something in there? Are you putting money on the table and saying, yes, I'm serious about this. Yes, I'm going to pay this back, right? They want to see effort. They want to see that you're putting skin in the game. So when you're looking at assets, the big takeaway here is your cash to close. Now your cash to close is all the money you're going to have to bring up front as a consumer to buy a home. So just a simple math equation here, your cash to close equals your down payment plus your closing cost. And in future videos, we'll get into what your closing costs are. But for right now, it's just your closing cost plus your down payment, right? That is the total amount of funds you need to bring. So where those funds come from are really up to you. So I've got a list laid out here below of different accounts that you may be using for your cash to close, right? So maybe you're using a savings, maybe your money's in a checking, maybe it's in a money market, maybe it's in a CD, retirement, investment. Maybe someone's being really nice and giving you a gift fund, right? There's so many different ways you can come up with money for your cash to close, but these are just a few of the common options that people are using when they're buying a home and they're using their funds to pay for that cash to close amount. So really what it comes down to with these different accounts is it liquid, right? Can this money be sent, wired? Can it be moved around? Can this money be accessed here to pay for things? So all these accounts can be turned into liquid, right? In some way, shape, or form. So those are kind of some common options. But again, just recapping here, this is just a 10,000-foot view of what you need to start thinking about when it comes to qualifying, right? What is the bank looking at? This is from a bank's point of view. What are they looking at? So hopefully when you're going through this, you're kind of asking yourself some questions going, hey, yes, I've got that. Yes, I have that. No, I don't have that. I need to work on this, right? So thank you guys for watching this. I hope this brought value to you. And again, this is just a 10,000-foot view. There is more to this, and we're going to get into that in future videos, but I just wanted to lay it out there and kind of give you the gist of what a bank is looking at from their point of view. So again, income, credit, assets. That's what you need to be thinking. Income, credit, assets, income, credit, assets. That is what a bank is looking at. And then you can just kind of go through these different components and kind of, figure out what is right and what's, most fitting for your situation. So hopefully this was helpful. The point of this video was just to share some education and some value to hopefully help you or someone you care about when they're looking at real estate financing. So thank you so much for watching. See you next time.